Like starting anything new, investing is a skill that you'll learn over time and for most through trial and error. But in this video, I'll explain what you need to know before you start your investing journey through some of my own mistakes and from my learnings of studying some of the great investors. The first on that list is that you need to understand your investing personality. To do this, you need to create a plan. This needs to comprise of a few elements, those main elements being, you need to understand your end goal. What is it that you're investing for? Is it lifetime wealth? Is it money just to be saved up for a large purchase? Or is it for overall financial security? Once you have this, you'll then need to look at your investing timeline. How long are you essentially planning on investing for? And just remember that those that invest over the long term have a lot higher chances of success than those that invest over the short term. And then finally, you'll need to choose a vehicle of what you want to put your money into, whether that is stocks, real estate, whether that's investing in businesses. This will differ person to person, purely depending on how much free time you have, what your risk appetite is like, and ultimately how much starting capital you have as well. Once you have those fundamentals in place, you can start focusing on the specifics of your personality. If you like the idea of stocks due to a lack of free time, and you have chosen to invest over a long term because your idea is just having a solid nest egg when you come to retire, then you can focus your choices to maximize the probability of this happening, such as investing in the S&P 500 index fund, where factoring in for crashes in the market, bull markets, it's averaged around 8% since its creation, allowing the everyday investor, just like you and me, to have a relatively low risk and relatively high ROI investment when invested over a lifetime. And due to the effects of compound interest, a £300 investment every single month at that 8% ROI would net you over 2.3 million in, let's say, 50 years. Or looking at your own investing personality and thinking, that timeline just doesn't work for me. I want to get as much money as I possibly can, as quickly as I can. Then maybe the S&P index fund isn't what you should be looking for. Maybe you have the free time and the risk appetite to go start something new, and you want to invest in real estate or you want to start your own business. But whatever it is, when you do come to invest, you need to create that investing persona and then use this to decide what your goals are and how you're going to achieve them. The next on the list that you then need to understand is the importance of consistency. Consistency when it comes to investing is almost just as important as starting. If you aren't consistent and you know you aren't going to be consistent, then I would go as far as saying don't even start investing in the first place, because you will just not see the outcomes that you're hoping for. This is the exact same for most things in life. If you are not consistent, you will be so much further behind somebody that is. I think going to the gym and not being consistent there will see you so much further behind and seeing so much less progress than somebody else who is going to the gym 3, 4, 5 times a week. And this is no different when it comes to your money. Think every addition to your investments is like lifting that little bit extra weight or training that a little bit harder, which will allow you to progress so much quicker. Let's say you have been completely oblivious to investing and you're now 30 years old. Say you also have £300 that you put away into a savings account every single month that nets you basically no interest. And you have now decided that the S&P 500 index fund is the vehicle for you to start investing in. You then transfer that £300 that you put away every single month into the S&P 500 index fund, and your friend does something very similar. But instead of doing it every month, they do it once every 3 months because they always forget. When you both come to retire at 65 years old, so investing that money now for 35 years, you will have around £688,000 saved up, while your friend, just £227,000, less than a third of the total amount of money that you now have saved up. And you may be saying, Lewis, is that not just from me adding that extra £300 every single month over that 35-year period? The answer is no. You will have only added an extra £80,000 over that 35-year period compared to that £400,000 difference. So make sure when you do start to invest that you just stay consistent. Benjamin Graham, the author of The Intelligent Investor, says it best. If you are shopping for common stocks, buy them like you'd buy groceries, not the way that you'd buy perfume. Now, some of the best ways to stay consistent would be setting up things like auto deposits, so you're not having to do it manually and you're not having to remind yourself every single month to do so. The second is to ensure you have a clear minimum monthly payment that's going in there every single month, not just however much you feel like on the day, because this is going to change based on your emotions. And yes, if you want to add more to that, then please feel free to do so, but have a minimum set up. And the third is don't wait for markets to crash or to rebound. Remember, time in the market is better than timing the market. Invest during these periods or you'll be missing out on thousands over the long run. And the next thing to know when you start investing is that diversification is essential. Diversification can allow your portfolio to grow even when one economy or one sector might be underperforming or even losing its value. It would be not only investing in tech stocks or AI stocks at the moment, but also investing into index funds or even a completely different vehicle like property. Diversification is a way of just spreading out your risk. Imagine a day if AI just completely takes over the world, like iRobot, and the stock market surrounding that just completely collapses. If you have all of your money tied up into companies such as Nvidia, AMD, Microsoft, Meta, you would probably lose a huge portion of your wealth overnight. And it would take years for your portfolio to bounce back, if it ever does. Yet, if you had money invested into these companies, but also the other 90% of your portfolio was spread out into other industries who have performed well or even overperformed, then you're likely to take a lot less financial hit than you would have done otherwise. Some of the cons of diversification, if there are, would be that yes, you might see slightly slower returns on investments depending on how you look at it. But remember, when it comes to investing, we're investing for the long term, because investing for the short term significantly increases your chances of losing. And yes, you may also get the fear of missing out when it comes to diversification if some of your other stocks are performing massively above the rest and you want to put more money into it to have greater capital returns. But at the same time, if those stocks all of a sudden plummet, you're putting yourself at a much bigger financial risk. Now, I've mentioned this index fund multiple times already on this video, but the S&P 500 is a great way of investing in the top 500 companies across the US and a way of spreading out your risk. And if you're looking for even further diversification from an index fund, then you could potentially look at the FTSE Global All Cap, investing in multiple countries, not just the US, and not just large companies, but also small and medium enterprises as well. And then the final thing when it comes to starting out in your investing journey, if you hear about a hot new investment, it's most likely too late. Don't buy into the hype. When you first start out in your investment journey and it comes to starting to put your money into these investments, often easy to find the latest trends or investments to put your money into. Because as the way things are with social media, everything becomes a new craze pretty quickly. But oftentimes, if you're hearing about this new craze, it's most likely too late. In the book, The Intelligent Investor, they talk about two different types of investments. One is the safe, reliable method, focusing on adequate gains, not extraordinary gains, and just preventing severe losses. As when it comes to investing, time really is your greatest asset, and this method is guaranteed to see you succeed. The second method of investment is following the hype or shooting for those extraordinary returns. And that is more of a speculative investor, such as buying stocks based on their projected future growth, which I honestly fell victim to this during the NFT hype. But this speculation is essentially gambling, as nobody can really know what the future value of these assets are really going to be. And the rapid growth that you might be seeing now is not going to last forever. So when you do see those huge increases in price, it often means that you're buying a little bit too late. Remember, the huge hype that comes around this drives the price up even higher, leading to riskier and riskier investments because of all the frenzy around it. And at the inflated price, those that bought at a lower price will now start to sell off their investment, leading the price to completely crash down as everybody starts selling. So if you do feel a need to invest into these hypes, set aside a small portion of your money to go and do this. But don't invest the large proportion of your wealth into these, because it just isn't sustainable. If they win, then great. If they don't, it's not going to hurt you for the long run, as you'll be regularly investing into true asset classes in the background, which are going to generate you the true real wealth that you're after. So to recap, when it comes to investing, make sure you've understood what you want to get out of this and where you want to start investing, by realizing your own investing personality. Once you have this, ensure that you are consistent with your investments to ensure you see the maximum growth over time. Allow your portfolio to be diversified. I currently have a mix of single stocks, and around 70% of my net worth is placed into the S&P 500 index fund. And then finally, do not buy into the hype investments, as this really will harm your future growth if that's where you're pushing most of your money into. Well, I hope you enjoyed the video. Let me know down in the comments if you've got any other tips and tricks for new investors starting out. And if you like the video, make sure you check out this video I did on how much money you should have saved by what age. And as always, drop a like and subscribe, and I'll see you for a new video next week.